What's going on at UPS is they are making progress and they're executing on their plan. And their plan really is to create a network that can not only handle but thrive in an ever-changing environment. And that change is being driven by e-commerce. It's being driven by the uncertainty around tariffs. And what they've been able to do is increase productivity through technology, whether it's automation or AI. And that also, they were stepping away from business from Amazon. They noted on their morning call that they're 3 quarters into a 6 quarter glide down of Amazon business. And the reason why they want to move away from Amazon business, it tends to be lower margin, lower yielding packages. But that's not to say that they don't want to totally walk away from Amazon because their return business is a good business for them. And we're seeing, the success in the numbers. And, going into the quarter, I think investors were cautious or had low expectations. And management kind of exceeded those with the results. And their outlook really shows us that, expectations for the fourth quarter in 2026, at least as it relates to, sell side analyst consensus, is probably a bit low and it needs to move higher.
Lee, can you get more into the cuts that we were talking about? 34,000 job cuts. Where were they seen, and what kind of, let's say, year-over-year cost savings does it expect in 2025 from all of this?
Yeah, so, what they're trying to do, their overall cost savings, which includes, the headcount reductions, they're looking to get $3.5 billion in cost savings this year. They've done around $2.2 billion of that so far. And some of the reductions are driven by, they offered early retirement for some of their drivers. They said they've had pretty good pickup with that. And that payoff should be about a year from what it costs. It costs something $175 to $180 million. And they mentioned on the call that it will take about a year to make those costs back up. So, it really should be paying for itself. And they're closing a lot of facilities. So they've closed something like 95 facilities so far. And that's being driven by they don't need the network they had when they were, really handling a lot of Amazon business. And now that, like I mentioned earlier, they're walking away from that business. They're kind of reconfiguring their network. And they're also, as I mentioned, they're increasing overall automation. They noted on their call that they've added automation to around 35 more facilities. And about 66% of their packages touch these automated facilities, which is around 300 basis points more than was last year. And that number is just going to continue as management makes more inroads at modernizing their facilities.
Lee, what is UPS, and maybe FedEx for that matter, how are they kind of talking to you guys about tariffs and how it might be impacting their business just as a big part of the supply chain?
Yeah, it's interesting. So for like a UPS, there's good and bad when it comes to the tariffs and the more protectionist policies in the U.S. We've ended the de minimis exemptions, which, stated that if a shipment came into the United States and it was worth $800 or less, it didn't have to pay a duty or a tariff. The Biden administration was working towards getting rid of that. The Trump administration brought that to the finish line. First it was just packages that were coming in from China and Hong Kong, and now that's been all packages coming to the United States, and that's hurting volumes. They noted their U.S. or their China to U.S. volumes were down around 20%, and that's having a negative impact. Now you look at their forwarding business, because of all these packages are now, if they are going to be coming in, lower value packages have to pay a duty. They need to lean more heavily on their customs business. So you've seen their supply chain business outperform this quarter, and I suspect a lot of that had to do with the additional fees that they generate from helping shippers clear packages through customs.